Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday, the 3rd of October 2019, and we're looking at why stock markets around the world fell yesterday and the day before. And we ask whether this is the start of an October global stock market crash. So let's investigate. Stock markets around the world fell appreciably yesterday. The FTSE 100 index experienced its worst day since January 2016, falling some 238 points, from 7,360 to 7,122, and is down a further 33 points this morning as we write this podcast, standing at 7,089. The French CAC 40 was down 2%, with the German DAX performing even worse, down 2.8%, and the Dow Jones down just under 1.9%, or 494 points, its second significant fall in 2 days. On the back of this, we have seen both gold and silver prices rise since its weekly lows on Tuesday, with gold moving up from $1,460 to its current level of $1,499, and will surely surpass that $1,500 level soon. And silver moving from its Tuesday's lows of $1,690 to its current price of $1,757. So, what caused markets to fall so significantly? Well, we shall split this into 2 parts. We shall give the official reasons being cited, which we agree with, by the way, plus our own additions, which are also having an impact, but are not perhaps headlined quite so brightly. Okay, the official reasons are as follows. 1. Poor US manufacturing data announced on Tuesday suggests that the US is heading into recession. In fact, the data was the worst seen in over 10 years. And secondly, President Trump gets blamed too for tweeting that the Fed has got its policy totally wrong, and that it now admits that another cut in October is a possibility, suggesting economic conditions are worse than even they thought. Well, this has in fact led to a number of very serious equity players, such as Alan Custis, head of UK equities at Lazard Asset Management, speaking on BBC Radio 5 this morning, stating, quote, "There was some very weak US economic data the day before, which came in at a multi-year low, and I think the markets thought, we've been thinking that the US economy has been pretty robust, and suddenly this was a bit of a wake-up call," unquote. This view is also supported by Phil Blancato, chief executive of Ladenburg Thalmann Asset Management in New York, who told Reuters, quote, "I am more concerned at this point than I have been at any point in the entire year. The key ingredient is when the business recession impacts the consumer and we get a total recession," unquote. So this ISM manufacturing report has essentially been the catalyst to cause these markets to fall, especially as the US has, to some extent, thought itself impervious to what's going on elsewhere around the world. Well, we shall give our additional reasons for these falls, but as mentioned earlier, agree with the earlier ones given. Now, there are quite a few of them, and we shall list them, but not necessarily in priority order. 1. Countries around the world have announced falling or reducing growth rates already, with worse to come, including the mighty China. And this, of course, is bound to have an impact on the United States. 2. The WTO rules in favour of the United States in its Airbus dispute, potentially resulting in the US imposing $7.5 billion worth of tariffs on the European Union, thereby extending the trade war. So we won't just have a trade war with China, but now with the EU. 3. Brexit concerns weigh on banking and financial stocks, which represent a fair percentage of the major stock indices. You see, as interest rates fall, or the prospects of them fall, then banks' profitabilities decline. And as they make up a large part of the major indices, their equity values will fall, thereby reducing stock market prices in general. 4. The ADP job figures yesterday showed jobs growth of 135,000, compared with the previous month of 157,000. Now, whilst this figure wasn't terrible and was close to expectations, it was, as some analysts called it, quote, a little soft, unquote, which does not bode well for the non-farm payrolls due out on Friday. And if one remembers, last month the non-farm payroll figures were terrible. 5. The Fed, having committed to pay $75 billion into the repo market each day until at least the 10th of October, suggesting banks are relatively illiquid at present, and with cash flows potentially worsening with reducing rates, this may necessitate them to take further action. 6. Information just being made public that JP Morgan may have been a major contributory factor to the repo crisis itself, being in a position of low liquidity. Some more geopolitical news. 7. Hong Kong experienced yesterday some of its worst violence in its recent history, as rubber bullets were fired and a journalist loses sight in one eye. In all, police made 269 arrests, more than on any day since protests began. More than 100 people were taken to hospital and 30 police were injured. In addition, another protester was shot on Monday with a live round in the chest. So this turmoil is upsetting markets. 8. The impeachment inquiry into Donald Trump gaining steam and increased activity. 9. 2 days of violence in Baghdad with a curfew imposed, with thousands taken to the streets in Iraq. 10. The Iran situation potentially worsening, with good friend of President Trump, the Saudi Crown Prince Mohammed bin Salman, warning that oil prices may soar if the world does not act to deter Iran. 11. Peru in turmoil after the president dissolves Congress, with the opposition claiming the move is a coup d'etat. And 12. Major ongoing protests in Haiti. And the list just goes on and on. Just a few hours ago, Asian markets also joined the global sell-off, concerned about global trade and reducing economic growth. The Nikkei 225 index closed down 2%. And even Australia's index has been affected, with the ASX 2000 losing 2.2%. Now, all of these factors and others, including detailed financial equations, also have to be taken into account when potentially assessing the future direction of stocks. Equations such as price-to-earnings ratios, dividend ratios, stock defensibilities, in addition to the basic acid test and liquidity ratios. So stock markets are worried at present, and we shall see later today the result for September's services and non-manufacturing PMIs and factory orders, and this will either add to the concern or detract from it. All that said, and in conclusion for now, we do not see this correction as necessarily being unhealthy, as we did not see it as unhealthy at the end of last year. A few thousand-point reduction of the Dow helps skim the froth off the top, as it were. However, of course, one has also to ask, is this just a small descent or the start of a crash? It's too early to tell, is our analysis right now. And all those now pumping out videos stating gold and silver are now going to the moon based on the last 2 days of rises seem to forget that prices are only a little higher than the week's opening and are around 2% lower than they were a month ago. As we stated in our weekly update on Saturday and in podcast videos since, let's wait and see all of the economic data coming out first before we can make a judgment on what the Fed is likely to do at the end of October. This will be a turbulent week, and we may have a couple more ahead of us. But there is also the potential that the markets in a couple of days, or in a week, could already price in any future Fed moves, meaning that when they actually turn into reality, markets will then just be accepting or even disappointed. We shall of course provide you with an update each day, and we'll send out an emergency bulletin by email if we see anything to be ultra concerned over. Meanwhile, for those members of the Inner Sanctum, we've placed a video explaining how the repo market works and how JP Morgan helped contribute to the lack of liquidity in the past couple of weeks. You can access it by visiting our website at illuminatisilver.com and looking under the premium video section. Now we end this podcast by sharing a piece of interesting historical data known as the October effect. And conspiracy theories and certainly pumpers will love this. And so we thought we should feed their soul, as they have been suffering recently. There have been a number of financial events occurring this past century or more, which has given October a bad name. Namely, the Panic of 1907, where there were multiple bank runs and heavy panic selling at the stock exchange. All that stood between the United States and a serious crash was, ironically, a JP Morgan-led consortium that did the work of the Fed before the Fed existed. You also had the crash of 1929 and Black Monday in 1987. So, don't be surprised to see videos come out stating this is the month of the crash, where gold and silver will skyrocket to the moon. However, for those of you who do not believe such stuff or superstition, can counter-argue that actually some of the worst crashes actually occurred in September, not October. The original Black Friday was in September 1869. Black Wednesday, also in September, was when George Soros raided the British pound. And September 2001 and 2008 provided larger single-day declines in the Dow than Black Monday ever did in 1987. With 2001, of course, being the attack on the World Trade Center, and 2008, the start of the subprime mortgage meltdown, trimming almost $2 trillion from the global economy in a day. So we've missed the September deadline, but some may argue that's the start, with October being D-Day. What do you think? Do share your thoughts, and thank you for listening. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer. Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners. Glory, glory, hallelujah.